Hey, it's Khalil with the Cashflow Contractor. Thanks for listening and tuning in. If you haven't hit the subscribe button yet, now's a great time to do it. If you are interested in building your construction business to be profitable and to run without you so you can have less stress, more time, and more money, we want to send you more content that can help you do that. I talk to contractors all the time who listen while they're driving from job site to job site, while they're taking care of stuff in the office or at home. And it's a great podcast for them because it gives them actual ideas and strategies they can use inside their business in a conversational format with two goobers like me and Martin. So if you're interested in that, you want more strategies to help you grow and improve your business, subscribe now. Now, let's get into the show. Today's episode is sponsored by OpenPhone. It's the perfect business phone system for contractors that you can manage just from your cell phone. If you're interested in hearing more about OpenPhone, check out the show notes to get an offer directly from them. The link is right here, and you'll find it down the show notes. Thanks for checking out today's episode, brought to you by OpenPhone.
Expert advice, practical tips, real-life stories. Have less stress, more time, and more money in your business. Welcome to the Cashflow Contractor.
What's up, Cashflow Contractors? Khalil here. No Martin today, and if you're checking this out on Spotify or on Apple Podcasts, you may want to head over to YouTube because this will be a very instructional, tactical episode on how to implement Profit First. If you're not familiar with Profit First, it's a great book by Mike Michalowicz. We had him on the podcast a while back. It's been several years, but it's a really great system that is designed to fit the habits that you have as a business owner. I think this is extremely helpful to use really every couple weeks, every week as a small business owner that is doing probably less than like $1 million in gross profit. I think it's really, that's where it really shines. If you're doing more than that, I think that this is a good tool to just see where you fit in the mix of things and what you should be working on. So, if you're on YouTube and you're joining us, thanks for checking this out. We're going to be going through our Profit First analysis template. A huge shout out to Lori Yearwood of Zeal Accounting. We will link to her in the show notes, as well as to her episode that we did many moons ago. She was the one that created this template, and it's one that we have used ourselves and with other contractors over the years. So let's dive in. What is Profit First? Essentially, if you're familiar with Dave Ramsey and the envelope system, it's a way of managing your cash. So if you are ever wondering where your cash is and how much cash you need on a week-to-week basis, this is a really great tool. It will help you with overspending primarily and understanding what you can spend without having to generate a cash flow report or a cash flow forecast or really look at your books in deep detail. So a really good litmus test for this is if you just look at your bank account as your financial planning, this is a much better way of doing it so that you don't run into trouble. So essentially the way that this is going to work is that you're going to have several different accounts. The first thing that you're going to do is you're going to go to your bank account, and you can likely do this through your bank app, but essentially you just create, it could be multiples more than this, but at minimum, you want to have an income account, an operating expenses account, a tax account, a profit account, and an owner's compensation account. So those will be the prime ones that you will use every single week inside of your business. Likely you only have a checking and a savings account right now. Your checking account is going to become your operating expenses account. And that's where you will do a majority of the things expenditure-wise. So just convert your checking and change the name to operating expenses. Really, no money should be coming into this account unless it's being a transfer from the income account. All money should be coming out of this. And essentially the way it works is anytime you send invoices, anytime you collect checks, all of the income will go into one account, your income account. So you should only see positive numbers in your income account as well as transfers out. So just as, the envelope system in Dave Ramsey, you take your paycheck and then you basically put a percentage of money into this envelope, this envelope, this envelope. And one is for groceries, one's for activities, one's for, children, whatever it is. You do the same thing for your business. So create those 5 accounts. You can do all those things right here. And then out of your income, you'll transfer to OPEX, to tax, to profit, to owner's compensation. And you may be asking yourself, well, how much do I transfer? And that's what we're going to get into in this next phase of the profit first analysis spreadsheet. So under TAPs, this tab under here, that stands for target allocation percentages. And essentially, depending on the size of your real revenue. Now, real revenue means gross revenue. So you have your top line revenue, and then whatever you minus cost of goods sold, what you pay your subs, what you pay for materials, you minus all that out, and that is your real revenue. So if you're doing between 0 and 250 in real revenue or gross profit, then you'll follow these percentages right here, and so on and so forth as you go through. If you aren't sure, then you can use these identifiers at the bottom. If you're typically just you and one employee, then you're likely in this first column. If you have employees and a really good CRM, then you're likely in this column. If you are spending money on advertising, then you're likely in this column. If you are building out systems and they are crucial to your business right now and people are following those religiously, you're likely in this column. If you have a second tier of management, like it's you as the owner and then you have a management team below you, you're likely in this stage. And then, above that, you are pretty stable and you have predictable growth year to year. Not just predictable revenue, but predictable growth. Hey, I know we're going to grow about 15% this year. Then you're likely in this stage. So those are the other identifiers that you can use if you're not sure on your real revenue right now. So first thing you do is you identify what these are. Let's just say that you are in this 500K to 1 million in gross profit. So your profit percentage, your TAP, your target allocation percentage for profit is 15%. For owner's pay, 20%. Tax 15, and then operating expenses 50, right? So what you'll do is you'll go over to this last tab, the profit first analysis. Let's say we're doing 1.5 in top line revenue, and we have 750,000 in real revenue, right? So we basically are operating at a 50% gross profit margin, which we're doing really great. So on this, if I remember my TAPs from the last page, I'm in between 500,000 and 1 million in real revenue. So over here, what I want to do is put 20%. Target is, let's go back and look at that. TAPs, 15, 20, 15, 50. So I'll just go in here, 15, 20, 15, 50. Okay. So we have that there. Then we can, if we knew what our actual was, which we don't know now, but maybe we have our historic data and we know exactly what these were, we can go ahead and put this information in right here. So let's say that I know that our profit was actually 7%. And let's say that, 150,000, I actually paid myself less than that. And sorry, this is actual dollars. So what we'll say is that our actual net profit, let's call it 10% for easy numbers, was 75,000. Okay. So then our owner's pay, let's say it was, I paid myself 100,000. And then our tax, let's say our tax bill, we were able to get away with 50,000. We got lucky. We had some expenses that we were able to write off, right? And then our operating expenses, so basically our overhead outside of our owner's pay. And so I can see that basically this is the number I have left. So let's say my expenses were 525, just to say that we used all of that revenue. Okay, so now we have a zero here, meaning we've calculated all this out. Obviously, these are really rough numbers, but that's what we have. So what that gives us is it tells us how we're doing comparatively, right? So if we were making this 750 in real revenue, and these were our percentages, this is where we should be. So we should be having more profit. We're less profit. We're missing our profit target by 37,500. We're missing our owner's pay by 50,000. We need to increase that. And then we're missing our tax by 62.5. That 62.5 was probably inside of our operating expenses, which lowered our tax burden. But we need to decrease our expenses by 150,000, right? And you can see that if we decreased our operating expenses by 150,000, which is a huge lift, then what that would do, we would pay more in taxes, but we would have more owner's pay for ourselves, and we would have more profit for ourselves. So what happens over here is these historical allocation percentages, rather than target, this is looking backwards. It shows us that we are really operating at a 10% net profit margin, and we are paying ourselves 13% there. So really our sellers' discretionary earnings, not including some that are probably in the operating expenses, are really 23% of this business, right? So pretty good, honestly. But from there, you would try to set your current allocation percentages for each quarter. Meaning, hey, I'm at 10% currently, and I need to increase. The fix is to increase my profit percentage, and I'm at 10% currently. Let's see if I can increase 1% each quarter. So I'm going to put in 11% here, 12% here, 13% here, and then 14% here, right? So those are my targets, right? And what that's done, you'll see here on these quarters. So this is Q1, Q2, Q3, Q4. It has increased the percentage for each of these quarters, right? So I'm trying to get 1% better at my net profit each month. And the idea is that you're paying your profit first, and then you're working out of your operating expenses after you've already paid your profit. So it causes you to shrink your spending. Hey, I don't have the cash to do it. I can't pay for it, is essentially the thinking. Let's go through each of these and figure out what the fix is, right? So the fix is that I need to increase how much I pay myself. Right now I'm paying myself 13%. I need to get to 20%. So 13.3. So let's just slowly increase that. Let's say that we get to 14, and then let's do 14 again for the next quarter, because I don't really need to pay myself that much, and I'm trying to reduce expenses. Then I'll do 15% and 15%, we'll say, okay? That's what I'm deciding to do and how much I want to improve. Then we have our next one. We need to increase our tax, right? And how much we put towards our tax. We've really only been putting 6%, and we need to be getting closer to 15%. I'd really like to, I don't want to owe the tax man, so I'm going to put 10% here and then 11%. So a big jump right away, but I'll get better and better as we go. And so hopefully we can end the year at 13% in the fourth quarter of how much we allocate to our tax account. Our operating expenses right now, we're at 70% historically, and we're trying to get down to 50. That's a lot to decrease. I'd have to decrease our expenses by 5% each quarter. And so, or really more than that if you think about it. But the reality is, let's see if we can get it down to 67%, or maybe we can do a big cut right away in the first quarter, and we can try to get it down to like 62%. And then from there, let's see if we can take it 2% each quarter. So 60%, and then 58, and then 56. Okay. So now it's going to tell me, hey, you haven't actually filled out all of these, right? So I still have some extra left over. So let's see, probably realistically, it's good that I probably add this back to my expenses. So I'll do 65% here. And then maybe what I can do here is do a bigger jump on my taxes to 12%. And then I'll put this at 62. We have 2% left here. Let's say that I really want to, let's really get that. I think we should focus on that tax account. So we'll do 13% and 59%. And then let's do the same thing here, 57 and 14, right? And that gets us closer to where we want to be of that 15%. You can see that we're at 0% left over. All of these quarters have been adjusted, right? So we're doing well. Now, the only hard part here is, especially for contractors, is they bring in this revenue, but they don't have a way of tracking the real revenue in real time, meaning they're getting the revenue and it has their cost of goods sold and their materials and labors inside that revenue. So what I recommend doing is actually having another account, like I would have a real income account and then like a all income account essentially. And then I would, on top of that, have a COGS account. So essentially you get that real revenue or the top line revenue in, immediately put what you need to put into cost of goods sold into your cost of goods sold account. And then the rest is your real revenue or real income account, right? So right away, you're not tracking inside of your profit first analysis what your cost of goods sold is inside of income. So hopefully that's a helpful exercise. But I would make sure that you're mindful of that as you go through this. Quick ad break, or maybe not so quick, but I wanted to do something fun and share a conversation with you with a contractor that we helped hire an assistant for with our Owner's Assistant Growth Kit. And this is with Sergio Garcia of Alpha Surfaces in Oklahoma City. He's a countertop contractor who is thrilled with his new assistant, and so much so that he can't wait for one of his best friends, Roberto, who's a garage door contractor, to get started with us in hiring an assistant. So listen in.
You get to meet Roberto. How do you meet him?
I did. Yeah, so we were at Council of Entrepreneurs. I'm not sure how long he's been in it or if he just joined.
Funny thing, because I told him about you, like every single time we met, I was like, man, you got to talk to Khalil. You got to talk to, you need an assistant. Like you need an assistant. You need somebody to help. But he didn't quite, he was like, man, but she's not here. I was like, I'm telling you, man, that's what I thought at the beginning. I thought it was like, I don't know, this is weird. She's a number. It's been working out perfect, man. I mean, he'll get you like the right candidate and he'll screen everything for you. It's amazing what you can do with proper help. We're on track, man. I think right now we got the new guy, Mauricio. He's going to start. Vicky's excited with his new position. Good. Natalie's is excited too because we're feeling like he's a missing part, the missing link between the office and Carlos is excited too. And man, I'm so happy. I think after Mauricio, 2-3 months, I think we can sit together and me and you and Ricardo and talk what's next for us.
Yeah, I'd love that.
And there you have it. Sergio was able to hire his assistant, Vicky, who we mentioned on the call, and it really unlocked a lot of growth for his company. They realized that they needed a shop clerk to really manage things in the shop and help with their production. And it's really unlocked so much. Now Sergio's really running smoothly. They're able to do more projects because they've eliminated the admin work from his role and his brother's Ricardo's role. And so now they're hiring a new shop clerk and they're going to hire another project manager assistant to help them even further as they grow. So if you're interested in our Owner's Assistant Growth Kit, check it out. There's a link down below. We'd love to help you hire an assistant who can unlock more time for you and your business to be more effective and more productive. Now, back to the episode. So now we have this all set up. We're ready to go for the new year. We feel good about it. We have our percentages that we're targeting and what our current allocation percentages are going to be for each quarter. So what do we do from now? Well, twice a month and before the pay periods for paying yourself and for paying your salaried employees, you want to jump in and you want on the 10th and the 25th to go through and take what's in your income account and transfer it out of there. So get it down to probably like $100 left in your income account so the bank doesn't see that it's at zero. Leave some sort of cushion in there, but you want to get it down to basically nothing. and it needs to be transferred out using these percentages, right? So if we're doing real revenue of 750,000, let's just do some quick math. 750 divided by 12. So we're looking at 62,000 in real revenue as our income. And then you split that in two. So we're looking at roughly 31,000, right? So we're going to start transferring. So right now we want to put in this first yellow box, the first, what is in our income account on January 10th. So let's just say in our income account, we have $31,689, okay? When we hit enter, it's going to calculate exactly what we need to be transferring out to ourselves and to all of the accounts. So into our profit account, we put $3,400, almost $3,500, $3,485 and 79 cents. Then in our owner's pay, we're going to put $4,400, 36 and 46 cents. Tax, $3,168. And then operating expenses, we're going to have $20,597. We put all that in there. So now we know what to transfer out. And then we can sit there and we can make our operating decisions off of this operating expenses. Now, you've got to be clear that out of those operating expenses, you're paying all your salaried employees, you're paying your rent, you're paying your insurance. So you still have to be mindful of all of those expenses that are overhead. But you understand this is my overhead operating expenses account. If I'm going to make a new decision about software, I need to see a certain number inside that account to be able to purchase that new software or run those ads or pay for a new piece of equipment or whatever it is, right? So that's how that works. And then you go through. So we make 33,598 the next month. And then we keep going. Let's say we did, we had a rough month or rough start to February. We only did 24,000 or so, but then we picked it up towards the end of the month. We got it back up. There was a huge one. We got to 40,000 in revenue. Then we go to the next one, and we generated, 38 this revenue this pay period. And we went back down to 30. We're just filling in fake numbers here for a little bit. Okay, going through. Wouldn't it be great if you could just make money this easily? You just type in numbers and it appears in your bank account. Oh, that would be bad. All right, last one on Christmas Day. All right. So the only thing I noticed here, the formula was a little bit wrong. So we need to add a couple more. Okay. So you can see here that it tallied up all of the profit from the profit columns or cells. into here so we can see our annual profit. And so right now, our annual profit's at 97,000 based upon the fake numbers that I put in here. And what you'll see is that our target profit was 112, right? So we are just shy of that. But if you notice before, we were only at 75,000. And so now us being at 97, we're really halfway, maybe a little bit more on the way to our, like about 8,000 more on the way to our target profit first amount. So again, you have to operate under the assumptions of this. We decreased our operating expenses by significant amounts each quarter. And so making those decisions, we now have less money in each of these. So you look at, for example, let's look at equivalent months. January and in November, we had a period where we made around 33,000 in revenue. Well, our operating expenses on January 25th, we got to transfer 21,000. But a similar amount on November 10th, we only got to transfer 19.5. So we were about 2,300 less in operating expenses between those two periods. So this is a cash management system. It's not perfect, but it really is based on your habits, and you have to be disciplined to, one, make sure you're using the analysis to when you make transfers twice a month on the 10th and the 25th. And two, you have to be very disciplined at using your operating expenses wisely and really saying, hey, I don't have the cash. I'm not going to pay for it. I've got to be creative, right? The two kind of warnings that I have: you're going to be tempted to dip into your profit and your owner's pay and transfer back to your operating expenses. And obviously that's okay, but you have to be very, very disciplined to say, no, I'm going to make a profit. I'm going to reserve this for profit, and I'm not going to shortchange myself. I'm going to reduce my operating expenses. And you're going to have to be creative in how you do that. That's a really great way to force yourself to cut out the unnecessary and reduce your overhead. Sometimes that means changing the status of an employee to part-time because, hey, I'm putting my business first. I'm putting profit first, because what ends up happening is you don't make those necessary changes that are difficult, and the difficult necessary endings that you come up against, because it's hard and you end up sacrificing yourself and your profit. And really what you're doing is you're sacrificing your family and your well-being and your livelihood and your retirement and what things look like for the future of this business, because you're worried about that relationship and or you're worried about the future and that what that not paying for that expense could look like. So you've got to be creative in how you handle this, and it takes a lot of discipline. The last thing I will say, credit cards ruin this completely. So I've experienced this firsthand with credit cards. It will make it really difficult. What people end up doing, and what I ended up doing several months, was I didn't have enough money to meet my operating expenses, and so I put it on credit cards. And yeah, that can work in the short term, but if you're not very diligent about that, you will rack up those credit cards faster than you can believe it, and then the debt service gets so high, and before you know it, you have to throw out this profit first system altogether and stop thinking about profit, because it's all going to pay these credit cards down. So those are my two warnings to you. Don't make the hard decisions to make the operating expenses work. And lastly, don't use credit cards on this system unless you are very, very, systematically religious about, I pay them down every month and I don't spend beyond what I really should. I'm not throwing on new expenses there. It's, hey, our software expense comes out of my credit card every month. I treat it like just a regular expense and I pay it off every single month. That's the only case in which it could work. So this has been the Profit First Analysis, deep dive into how to actually use it. The link to this template, you can download it by submitting the form in the show notes. It'll subscribe you to our newsletter, and we'll also send you this Profit First template in an email. I think you should check it out. I think you should share this with anybody who you think is having challenges with managing cash and who wants more profit, which honestly is most contractors, most business owners in general. Hope you enjoy it. Thanks for checking it out. And yeah, hope to see you on the next episode. You made it to the end of the episode, but before you go, if you found yourself thinking about growing your construction business while listening today, I want to share something with you. It's called our 24 Things to Hiring and Training the Perfect Executive Assistant for Your Construction Business. And it's a free guide that we've created. It's not theory, it's what we actually use to help contractors hire the perfect executive assistant. And really, we help you find ways to delegate over 50% of your current workload and get back 20 hours of your time every single week. You didn't start your construction business to just be doing admin work, to be buried in paperwork and endless admin tasks. This is the guide that shows you exactly how to find and train someone who can actually take all that weight off of your shoulders. So this is a real actionable, great PDF that has templates and processes. It's really, really great. And I want you to check it out, even just to get your feedback and how we can make it even more valuable. But I know that you're gonna love it. The link is in the show notes. Please download it. We'd love to see how much of an impact it makes on you and your business. Thanks for listening to the full episode. Check out the guide. It's free. No reason to hesitate. No reason to wait. Download it now. And before you go, I just want to ask for your gracious subscription to our podcast. So if you have 2 seconds, it means the world to us. Just subscribe on YouTube, Spotify, Apple, or if you'd like our weekly newsletter delivered to your inbox whenever we release an episode, please subscribe in the show notes. Every week, we're talking about real strategies on how you can grow and build a profitable construction business that runs without you, so you can have less stress, more time, and more money. Click subscribe wherever you listen to the show, and thank you again for checking out the Cashflow Contractor. See you on the next episode.